If you're looking for a summary of Japan's Pillar 2 legislation, you're in the right place. Hi, I'm Shin Yamaguchi, inbound leader with PwC Tax Japan. I'll be covering Pillar 2 in 3 minutes, and then sharing some general observations around this year's reform. As part of the 2023 tax reform, Japan is introducing an income inclusion rule, or IIR, that will apply to fiscal years beginning on or after April 1st, 2024, in line with the fiscal years of the vast majority of Japanese corporations. Over 800 Japan-parented multinationals are expected to be in scope. Japan's IIR is closely aligned with the OECD's Globe Model rules, effectively implementing a 15% global minimum corporate tax. The tax reform legislation, which was approved by Japan's parliament in March of 2023, addresses in detail key provisions such as the determination of constituent entities liable for top-up tax, as well as the computation of top-up tax itself, while also incorporating by reference the temporary safe harbor rules. Further guidance will be provided by the Japanese tax authorities through enforcement orders. From a procedural perspective, tax legislation can only be enacted in Japan by way of the annual tax reform. In addition, the Japanese government has long been firmly committed to Pillar 2, having also played a leading role in the OECD BEPS initiative. In this regard, the introduction of the IIR in this year's reform was widely expected. As to QDMTT, the Qualified Domestic Minimum Top-Up Tax, and the UTPR, the Under-Taxed Profits Rule, we should expect Japan to implement these rules as well. The question is a matter of time. While the earliest implementation would be in 2025 by way of the 2024 tax reform, this will depend in part on where other countries stand. And as a practical matter, the Japan QDMTT may have limited impact, given that it is unlikely that Japanese subsidiaries would have an ETR of less than 15%. When we think about Pillar 2 in Japan, the interplay with the CFC rules is critical. Japan has a robust CFC regime, which keys off of ETR and economic activity. And so, for example, in the case of a CFC with a less than 20% ETR and limited economic activity, there could be a full income pickup from the CFC. Taking this into account, Japanese corporations, by and large, were not expecting material top-up tax exposure from a IIR perspective, with a few exceptions depending on facts and circumstances. That said, now that we know that QDMTT will be taking priority over domestic CFC rules, the question is whether QDMTT will be creditable for Japanese tax purposes, something that the government will have to address in due course. Switching gears to the reform more broadly. It is often said that our annual tax reform offers a window into the social and economic issues that Japan must address. 2023 is no exception. And in going through the legislation, 2 issues stood out. First, the need to shift household financial assets from savings to investments, a long-standing challenge for Japanese society, yet vital to stimulating economic growth. And second, bolstering the startup ecosystem, which will be critical to driving much-needed innovation. To its credit, this year's reform introduces various measures designed to address these issues. With an uncertain geopolitical landscape, inflationary pressures, and a fluctuating yen, Japan has much to navigate. And while tax is but one piece of the puzzle, it should continue to play an important role, not only on the policy side, but also in practice, as Japanese businesses take on supply chain, digital transformation, and ESG, promising for an exciting time for tax in Japan. Thanks for tuning in today, and please reach out if you have any Japan-related questions.